In this submodule, we will talk about budgeting and cash flow. If you are going to ensure that your NGO is able to address the vision it was created for, then you need to ensure its financial health. This implies budgeting and cash flow forecasting within your organization. By creating and managing budgets for your organization's projects and activities and forecasting your organization's cash flow, you can better assure the financial health of your organization and sustain the impact you aim to create. In this module, we will start with the basics of budgets, and then we will look at why budgets are important in your organization. We will then look more specifically at project budgeting. Following that, we will take a look at the basics of cash flow and run through a practical example of a cash flow forecast. The central learnings of this submodule are: 1. A budget is a financial plan. It estimates both the income and the expenditure for delivering a set purpose over a defined time frame. 2. There is no standard budget and no standard template for preparing one. It is important that any budget is fit for its purpose and presents the right level of information for its intended user. 3. Budgets are important for an NGO to plan and prioritize, to fundraise, to monitor, and to forecast. 4. Budgets are often used to form a contractual basis for donor-funded projects. 5. Cash flow refers to the movement of money through your organization, what comes in and what goes out. 6. Budgets and cash flow forecasts can be made on different levels, for example with regard to singular activities or the organization as a whole. 7. Forecasting and monitoring cash flow is essential to ensure that your organization receives enough income at the right time to cover its expenses. 8. A period of deficit in a project's cash flow isn't uncommon and doesn't necessarily need to be a problem. So, starting with the basics. A budget is a financial plan for delivering a set purpose over a defined time frame. It is an estimate or pre-commitment upon the income and expenditure required to achieve the purpose in the given time frame. A budget's time frame and purpose could be defined according to a standalone activity, for example, a party for your volunteers. Alternatively, the time frame could be defined by a wider period in which the purpose should be achieved. For example, the budget for office renovations from 2020 to 2025. And it could be as simple as the budget for the office coffee supply over a 12-month period. They can also be more complex. For example, the time frame and purpose can be defined according to a project, such as a donor-funded youth project delivered over 2 years. Further still, a budget can be for all the activities of your organization over the period of 1 year, which can be referred to as your NGO's annual budget. There is no standard budget and no standard template for preparing one. It is important that any budget is fit for its purpose. When creating a budget, you should consider who the user of the budget is. Is it for you, your board members, your team leader, your NGO's members, a donor, or someone else? Any budget should present the right level of detail to allow the user to understand and use it effectively. For example, the office renovation budget may need to be very detailed with itemized costs for you and your team leaders, so you can all have a clear consensus on how much has been planned to spend on each item. Whereas, if you present the budget to your board for their approval, they may prefer to see an overview of the budget. For example, the costs for each year over the period of 5 years, and maybe the global costs allocated to each area of the renovation. But don't forget that a budget should present the income as well as the costs. In this case, the income could come from different sources. For example, from membership fees, sponsorship, and a grant from the local municipality. If the income and expenditure are equal, then you have a balanced budget. If the income is less than the expenditure, you have a deficit budget. And if the income is more than the expenditure, you have a surplus budget. This is often referred to as the bottom line. If your budget's bottom line shows a deficit, you may have to look for additional funding, lower your expectations, or maybe conclude that the activity or project isn't feasible. If your budget's bottom line shows a surplus, you may in some cases have to justify how the surplus will be used or allocated, as a surplus could constitute as a profit, which may be ineligible depending on the legal status of your organization or the guidelines of your donor. So, budgeting requires accurately estimating income and costs before they occur, and often committing to those estimations. This can be challenging and may even feel risky, counterproductive, or restrictive to your ambitions. However, budgets can have a number of important roles within an NGO. Budgets can be tools to support the strategic planning of your organization and to decide what projects and activities to prioritize based on value for money and cost versus benefit. For example, when making your organization's annual budget, you may find that your organization doesn't have the financial capacity to undertake both the party for the volunteers and the office renovations. So you may have to prioritize one over the other or reduce your expectations of them both. Budgets are also an important part of fundraising. It is unlikely that a donor will fund your project idea without knowing how much it will cost. We will come back to this in the next slide. Budgets can be used as a tool to manage and monitor your organization's activities and projects. Taking the example of the party for your volunteers, the budget will help you to monitor that you're not overspending. Or in the case you have overspent on the entertainment, how much will you then have to cut on the catering? Budget can also help you forecast. For example, in your 2-year youth project, the cost incurred and the income received during the project may not follow regular intervals. Costs may be higher at certain milestones within the project, and the income may not align with those milestones. Using the project budget, you can plan ahead and forecast your organization's cash flow. We will look at cash flow a little later in the module. For now, let's look a little more at project budgeting. Budgeting is an important part of any project. When seeking funding for your project idea, it is highly likely that donors will ask for a budget. The way in which donors ask you to calculate and present the budget may vary. For example, some funding programs may use lump sums, which is a fixed sum of funds for a particular delivery, whereas others may ask for a detailed and accurate estimation of real costs. One project can also have more than one mechanism to calculate the budget. For example, lump sums could be used to calculate the budget for travel, and real costs could be used to calculate salaries within the project. But regardless of the donor's mechanisms for calculating and presenting the budget, it is important that you create an accurate budget for your project internally to evaluate the feasibility of what you aim to achieve in the project and to help you manage and monitor the project's implementation. It is also important to consider that the budget you provide to the donors at the time of applying for the project is often used to form a contractual basis for the project on its approval. If you find that reaching your project's aim is more costly than originally thought, it is often unlikely that the donor will provide additional funds, but will expect the project aim to be achieved nevertheless. It can often be tempting to make a project budget that fits to the donor funds that are available, but be careful. You will have to deliver on your promises. The types of cost in a project can be varied and broad. When creating a project budget, it is important that you consider all costs, including costs that are less obvious and costs that occur indirectly as a result of the project. It is also important to consider that some costs may not be covered by the donor or only partially covered. It may also be the case that the donor distributes part or all the funds after the costs have been incurred, or when the project's purpose has been realized. This is where cash flow comes into play. Cash flow simply refers to the movement of money throughout your organization, what comes in and what goes out. Forecasting and monitoring cash flow is essential to ensure that your organization receives enough income at the right time to cover its expenses. Analyzing and forecasting your cash flow is a form of budgeting, and in the same way, it can be done on different levels. For standalone activities, for a series of activities, for a project, or for the organization as a whole, including all of its activities and projects. Cash flow forecasts are an important tool in the financial administration of your NGO. You may have created a balanced budget for your activity, but you need to take into account that the costs and income will probably not occur at the same time, and it may be that the costs come before the income. Let's take a closer look. Cash flow forecast. As with income and expenditure budgets, there is no singular way to prepare and present a cash flow forecast. You should find your own way to make a clear and understandable forecast that is adequately broken down to give a precise picture. For example, depending on the scope of the budget and its time frame, you may choose to make a forecast for each month, for quarterly periods over the year, or for every 12 months over 5 years. The tables in this slide show the components of a simple consolidated cash flow forecast. The left-hand column shows the intervals of the forecast within the budget's defined time frame. The next column shows the cash outflows or expenditure that is expected to occur during each given interval. The following column shows the cash inflows or income that is expected to occur in each given interval. The final column gives a rolling balance of income versus expenditure in each given interval, taking into consideration the balance from the previous interval. If the cash flow forecast is based on a balanced budget, the total outflow and inflow should equal the same amount, and the end cash balance should be at 0. Let's take a look at a working example. Let's say that your organization has been given a project grant of €10,000 to make a community garden. The donor has agreed to provide 50% of the grant up front and 50% halfway through the project when you have provided a mid-term report. In this case, referring to your cash flow forecast, you can add €5,000 in the cash inflow column for the first and third quarter. You have made a detailed income and expenditure budget that is balanced. Based on your budget and the project activity plan, you have made a forecast of when the costs will occur within the project timeframe. Your forecast costs of €3,000 in the first and second quarter and €2,000 in the third and fourth quarter. Based on your cash flow forecast, you can see that the second quarter may be challenging for your organization. In this case, you may choose to break the forecast down further to a monthly basis and evaluate whether your organization has the financial capacity to cover the cash deficit in that period. It is not indicating necessarily that the project is not feasible. However, it is allowing you to consider how you will ensure the cash flow in that period. How can you cover the cash deficit in that month? Possibly your organization has some cash reserves. The organization could take out a loan from the bank, or the organization's director may be able to lend funds to the organization. A period of deficit in a project's cash flow is not uncommon and doesn't necessarily need to be a problem. What is important is that you are aware of it, so you can find a sustainable way in which to manage it. Of course, this is a relatively simple cash flow model for the purposes of giving an example. Hopefully, your organization will have a portfolio of many exciting projects that you will create budgets and cash flow forecasts for, also taking into account your organization's other ongoing costs and activities. But don't worry, you will know your organization the best. Just be realistic and accurate, and take the time to find an approach that works best for you. By creating and managing budgets for your organization's projects and activities and monitoring your organization's cash flow, you can better assure the financial health of your organization and sustain the intended impact you aim to create through your projects and activities. We have now reached the end of this submodule. Let us sum up the lessons learnt. 1. A budget is a financial plan. It estimates both the income and the expenditure for delivering a set purpose over a defined time frame. 2. There is no standard budget and no standard template for preparing one. It is important that any budget is fit for its purpose and presents the right level of information for its intended user. 3. Budgets are important for an NGO to plan and prioritize, to fundraise, to monitor, and to forecast. 4. Budgets are often used to form a contractual basis for donor-funded projects. 5. Cash flow refers to the movement of money through your organization, what comes in and what goes out. 6. Budgets and cash flow forecasts can be made on different levels, for example with regard to singular activities or the organization as a whole. 7. Forecasting and monitoring cash flow is essential to ensure that your organization receives enough income at the right time to cover its expenses. 8. A period of deficit in a project's cash flow isn't uncommon and doesn't necessarily need to be a problem.